Hi everybody, we're back to part 2. Alright, so this is an example of what a profit center would look like, right? Not only are you in charge of revenues, but you're also in charge of expenses, right? As we were saying up here. Now, one thing I want to point out to you here is this service department charges piece. And you see that each, the theme park and the movie division for this little example here, have purchasing, payroll, and legal departments. Well, the question is do they have their own purchasing, payroll, and legal departments? Or do they share those services? Okay, a lot of times decentralized organizations will share services, right? Why should everybody have their own purchasing? Why should every business have its own payroll? Why should every business have its own legal department? The idea is that oftentimes we share services that kind of cover multiple companies. And with those, we have to figure out a way to share those costs. So we're going to get into an example right now of service department charges, sharing them. Right, so here we go, what I just said, sharing the cost of services between the different divisions. And some examples, right? Research and development, that's R&D, legal, payroll, purchasing, IT, right? Information technology, and human resources. All right, I couldn't think of what IT stood for a second. All right, so here's a little example we've got here. It says the centralized computer technology department of Hardy has expenses of $320,000. The department has provided a total of 4,000 hours of service for the period. Retail division used $2,750 of computer services, and commercial used $1,250. Okay, so think about a computer department. Very often, think about how you would bill costs. Let's say that you've got one department who uses a lot of the computer people's time, and you've got another department who almost never uses the computer people's time. You would have to figure out a way to split the charges. So sometimes if you remember, well, if you've ever worked in a business, very often you submit a problem with the IT department, and they call it a ticket, right? So it would be, they would classify, they would say, all right, this ticket went to the retail division, this ticket went to the commercial division. So it would be based on how many tickets there were, how they would split their charges, right? Same idea with payroll. You know, maybe one business has 100 employees, another business has 1,000 employees. Well, obviously 1,000 employees take more time, so you would split it based on those terms. Legal could be billing hours. Let's say one of the businesses had lots of lawsuits, and one business had no lawsuits. They would bear the burden, the one who had the most lawsuits will bear the burden of the legal department's costs. Okay, so you've got to think of reasonable ways to split these things, these service department charges that serve more than one company, or one arm of the company. Okay, so looking at this one, I'm doing this a little bit shorter than the way that Cengage does it, so it may not match exactly how you have to input it for your homework, but the way I do it makes more sense to me, so that's the way we're doing it. All right, the retail division. The retail division used 2,750 hours out of a total of 4,000 hours of service for the period, right? So retail used 2,750 out of a cost of 4,000 hours for the period, right? Commercial used 1,250 hours out of a total of 4,000 hours for the period, right? So we're going to take those numbers, and what we're doing is we are prorating based on how much each department used. So the overall costs of the technology department are $320,000. So we're going to multiply each of these times the overall cost of $320,000, which winds up being $220,000 goes to retail because they use them far more, right? 2,750 hours versus 1,250, and $100,000 would then go to the commercial department. If you want to kind of double check for yourself, make sure you didn't miss anything along the way, you add them together, they should come out to the total cost that you're trying to allocate between the two. All right, so I think my way makes more sense. They do it like in multiple steps, but you do what you need to do. All right, so the next part of this, it just kind of builds on that previous problem. It's kind of making sure that you understand then how it plays out between the two divisions, like how you would report those shared services. So I think I'm going to, let's see, hang on. Oh, let's pause you guys so you're not hanging on watching me look for papers. All right, so the idea is they're saying how then would the retail division's income statement look, and how would the commercial division's income statement look, or income from operations, as far as they go, right? So the idea is you'd have the same standard sales minus cost of goods sold, gives you gross profit, minus selling expenses, I'm going to go off the page here. Actually, let me undo that last line. We'll do it all in one place. Minus shared services. I think they call it service department charges. So the idea is you'd have the retail division and the commercial division. I think I'll just do one. You've got sales of $2,150,000. You've got cost of goods sold of $1,300,000. It gives me gross profit of $850,000, less the selling expenses, which are given to you of $150,000, and then less the service charges for the retail department, which I'm going to grab from right here, the $220,000. Okay, so then we're going to subtract the $220,000, and you'd have $480,000 as their income from operations. Commercial, you do the same thing, but you would grab the $100,000. So you're just trying to show you how it would play into an income statement. Okay, nothing too crazy. All right, now I know you don't have this in your packet. I get it. I deleted it. It's something I do in a face-to-face class. However, or I have the students do on their own, I just wanted to kind of give you a hint a little bit on some of this problem. All right, so this is one you're going to have for homework. The idea is you're doing the same thing. It's a shared service department charges. But I want you to realize you're splitting two things. You're doing purchase requisition, which is a shared purchase department, and you're doing payroll. So what you would do is this is the data for the payroll. And this is the data for the purchasing department. Okay? And when you're doing this, what you're doing is they're telling you this is how many purchase requisitions went through the residential. This is how many purchase requisitions went through commercial. This is how many went through government. You add all those together to get to your total purchase requisitions, and then you can do the math on how many used more, right? 7,500 over the total, 3,000 over the total, and so on, times the cost of $40,000 for the year. These guys, though, are a little bit trickier. You've got weekly employees, you've got monthly employees. I never actually heard of a monthly employee. People usually at least get paid twice a month, but we'll go with their example. So the idea is that for each of these, it'd be times 52, right? Because they get paid every week. And it's not unusual to have different classes of employees, like hourly employees tend to get paid weekly. Not always, but administrative employees tend to get paid bi-monthly, but in this case, monthly. So you'd have to multiply these guys times 12. All right, so just kind of giving you that heads up for when you could do that as a homework problem. Moving on. All right, I think if I'm quick on this, we can finish it in one. Investment center, it's your third category, right? Decisions. The managers make decisions that affect cost, revenues, and what to do with the assets once you have them when you're investing, right? What do you do with that extra money? All right, so, and that's what this little example here is, just a picture of revenues, operating expenses, shared services, and so on. It really doesn't talk about what you do with the money afterwards, though. I don't know, that's not the best example, but I did take it from your book. All right, ROI, that's one of the calculations that we perform. It's called return on investment. The idea is the higher the ROI, the better the division is at using its assets to generate income, all right? Meaning that if a business has a ton of assets, they should be generating income for you, right? If they've got machinery and equipment and, well, same thing, right? Buildings and all kinds of good stuff, they've got all the assets. Are they generating good income for you, right? And if you've got multiple divisions, the idea is like, let's say I'm running my business at the top level, I've got $1 million extra, and I'm looking at my multiple divisions and I'm saying, who's using their money the best, right? Because whoever's using their money at the best, I'm going to give them more money because I want them to continue to use it and make me more money, right? So that's the idea of ROI. We're looking at who's investing their money the best. And this is the formula for ROI, or you can split it into two pieces, which is referred to as the Dupont Formula. And it's two pieces. You've got a profit margin piece, which is income from operations over sales. And I know it looks ugly. Oh, you know what? Why do I even have the tabs on? You know what? I've gotten so used to tabs that I always have tabs. Sorry. Let's see. Oh, not tabs, but the paragraph markers. That's just how I operate. Okay. Sorry, that was ugly. You've probably been dealing with the ugly for how many slides now? Anyway, ROI. Profit margin piece is the income from operations over sales, and then the investment turnover is sales over invested assets. So you can look at them separately because they each mean they each mean different things. We're not going to go into that in any level of detail. I know your book goes into it in quite a bit of detail. Let's save that for your finance class, not for your accounting class, because that is not my area of expertise. But anyway, if you look at this from basic math standpoint, the idea is you could cross out the sales and you'd have income from operations over invested assets to give you your ROI. Or like I said, you could look at them separately. Okay. Profit margin gives you operating profitability, investment turnover is operating efficiency. Again, that is a finance area that we're not getting into. Okay, so just a quick little example on how this works. Super easy. Briggs Company has income from operations of $36,000, invested assets of $180,000, right? And sales of $720,000. And they want you to break it into the profit margin piece and in the investment turnover piece. So we're looking at 36,000 divided by 720 profit margin, which is actually 5%. And the investment turnover is 720,000, divided by 180,000. I don't finish my zeros. And that winds up being 4. So you're looking at a 20% return on investment. So the idea being, if I were to give them $1 million, I would expect them to generate somewhere around 200,000 for me of extra income. That's what we're looking at here. All right. Moving on. Residual income. It's a slight variation of the same concept. The idea is, how much are we making beyond the minimum acceptable return from operations? Like if I decided my business is, if my business has this many assets, I expect them to generate at least a certain percentage of return for me, right? I expect them to at least produce a certain amount of income for me. So, and anything they make beyond that certain level of income, which is considered the minimum acceptable return, anything beyond that is like extra. It's gravy, right? It's called residual income, anything beyond that number. So if we're asking what's the residual income for this particular division, we're saying the assets of the division are 74,500, and my minimum acceptable rate of return on those assets is 12%. So I expect my company to at least earn 12% for me, and that comes out to be $8,940,000. Well, the company earned more than that. They earned $12 million. So to the extent that they earned more, good for them. That extra, I think I have enough comment. Yeah, I do. Okay. That extra is considered residual income, which is $3,740,000. Okay, residual. Okay, well, at least you hear my words, even if my handwriting is almost impossible to read. Okay, so that's the concept of residual income. All right, a little bit more and then we're totally done. So I'm just going to keep us going. I know we're 13 minutes. Thank you for sticking with me. All right, balanced scorecard. The idea is, I mentioned it earlier, it's not just about financial performance measures, it's about non-financial performance measures. One of the things they still use is balanced scorecard. They used it like 20 years ago. We were talking balanced scorecard. Apparently it's still in use. So here we are talking about it today. The idea is that you shouldn't be just looking at one area of business. You shouldn't just be looking at the financial piece, though it is absolutely an area of the scorecard. You should be looking at all different areas and making and setting goals and having measurable objectives for each one of them, right? Like number of new products. Maybe we want to make 10 new products a year, or we want to increase it by 5%, or maybe we want to decrease employee turnover by 15%, something along those lines. Customer service, internal processes. All of these things are important to running a business, and they're just giving you some examples of what you could consider into each of these categories. And the idea is that a well-balanced business does look at all of those things together. Okay, and it's not a bad idea. It keeps you from focusing on too heavily an area. You do need to look at all the areas in order to have a well-run business. All right, transfer pricing. Last thing, I just want to talk about it for a second. If you've got these multiple businesses, but they're all under the same header, what if you're buying things from each other? How do you do that? Like, do you charge them the same as you would charge an outside customer? Do you charge them something less? How do we do that? Well, that's really up to your company to decide how to do. And there's a couple of different approaches. One is the market price approach, meaning like if you've got, company A and company B all within the same company overall, but, you've got one segment and another segment, company A and B. Maybe company A has something company B wants, so they could turn around and sell it to them for the same thing they would sell it to anybody else for. That would be the market price. All right. The other way they could do is company A could sell it to company B with the cost price, right? So that is however much the variable costs were, that's how much we're going to charge company B, because it seems silly to be making a profit when we're all under the same overall company, right? So cost price, variable cost. So if it makes me, it costs me $3 to make it, that's what I'm going to charge you. All right, so there's cost price. And then there's something in between, a negotiated price, somewhere between what I would charge an outside person and what I would charge, what my actual costs were. And, you could see that company A may choose a negotiated price approach simply because they're going to look bad if they're not doing well, but maybe they're just selling all of their stuff at company B, so it doesn't look like they have great sales. Right? So company A's manager cares about how his numbers look too. So a cost price approach might not show well. A market price, company B might be like, forget you, why am I going to buy from you? I'm going to go buy from somebody outside if I can buy it for the same price as anybody else. This guy's also going to give me, a discount on my freight and whatnot. So anyway, negotiated price approach tends to be the way. There's no right or wrong answer between the companies, how they work with one another, but you have to realize that there needs to be established some sort of protocol for those things. Okay, we're at 16 minutes and we're done with this chapter. Have a wonderful day, folks. All right, enjoy your homework.